In February 2025, Bank of America warned that the stock market could be heading for a sharp drop. They argued the stock market was showing clear signs of a growth stock bubble, and they issued that warning while the S&P 500 was hovering near all-time highs. Not long after, the market sold off sharply, falling by roughly 20% in the weeks that followed. Now fast forward 1 year to today, the market is back near record highs, and once again, Bank of America is sounding the alarm. This time, they warned that investors may not be prepared for a correction, and that several familiar sell signals are flashing at the same time. One of the main reasons behind Bank of America's warning comes down to how investors are positioned today. Since the tariff-driven sell-off last year, the S&P 500 has rallied by nearly 40% in less than 12 months. That kind of performance tends to feed on itself. As markets rise, confidence builds. As investors' confidence builds, more money flows in. And as more money flows in, prices get pushed even higher. That feedback loop can carry markets a long way, but it also means positioning can become crowded when optimism spreads too far. And right now, some of the data suggests that may be the case. This chart shows how much of the average household's wealth is now tied up in the stock market. And right now, nearly half of their assets are invested in stocks. That's higher than what we saw during the dot-com bubble in the late 1990s, a period that's now remembered for extreme optimism. At the same time, while stock exposure is at record highs, personal savings rates of the average American are near record lows, sitting at just 3.5% of income. In other words, investors aren't just optimistic, they're already fully invested. And it's not just households. Institutional investors are in a very similar position. According to Bank of America's latest survey, cash allocations among some of the world's largest fund managers have fallen to around 3.2%, one of the lowest readings on record. That matters because cash isn't just a defensive asset, it's also fuel. When markets sell off, cash is what allows investors to step in and buy the dip. But when cash levels are already depleted, that buffer disappears, and that's when markets tend to become more fragile. However, it's still important to note that low cash levels by themselves don't automatically trigger a sell-off. In fact, when we look back at periods like 2004, 2011, and 2013, fund managers were also holding very little cash, but the S&P 500 kept climbing anyway. So why is Bank of America more cautious this time? Well, this chart might explain it. It shows the S&P 500's price-to-earnings ratio, a simple way to think about how expensive US stocks are. In past periods when investors were all in, valuations were much lower. Back in 2004, the S&P 500 was trading around 16 times earnings. In 2011 and 2013, valuations were even cheaper, closer to 13 times earnings. And in those instances, optimism was largely grounded in reality, as the economy was recovering from recessions, and cash was being deployed into relatively undervalued assets. Today, the setup looks very different. The S&P 500 is now trading at around 22 times earnings, nearly double the valuation levels seen a decade ago, and around the same level we saw during the dot-com bubble. That suggests a large part of future growth may already be priced in, which means additional good news might not push markets much higher. And when you combine record high valuations with record low cash levels, you end up with a market that's far more sensitive to disappointment. Optimism is high, but the margin for error is thin, and we may already be starting to see signs of that tension emerging. The Magnificent Seven, companies like Microsoft, Amazon, and Google, have actually started to roll over after their earnings releases, and that's happening even though their results have generally met expectations. At the same time, on a relative basis, the S&P 500 is off to its worst start versus global markets in nearly 30 years. That combination has led some investors to worry this could be the early stages of another bear market. However, when we look at the equal-weighted version of the S&P 500, the RSP, the picture looks very different. The index is still pushing to new all-time highs, and if we zoom in, it's actually been outperforming the Magnificent Seven since the start of the year. The RSP gives the same weight to every company in the S&P 500, treating the mega-cap tech giants no differently than smaller firms. It essentially strips out the dominance of the Mag 7. So what this could mean is that capital isn't necessarily leaving the stock market. Instead, it may simply be rotating away from the most expensive parts of the market and into areas that are still relatively undervalued. And indeed, the valuation picture helps explain why this rotation is happening. The Magnificent Seven are still trading at close to 30 times earnings. The S&P 500 as a whole is around 22 times, but small and mid-cap stocks are sitting closer to 16 times earnings. If capital simply continues to rotate into other parts of the market, it could create pressure on certain segments, but it doesn't necessarily point to a full-blown crash. This kind of move looks very different from a recession-driven or macro-led sell-off, and that's why Bank of America isn't isn't calling for panic, but for preparation. Their view is that diversification matters more than ever, moving away from the most crowded, expensive parts of the market and toward areas like small-cap stocks or international equities while still being ready for bouts of volatility or a correction. Of course, markets are inherently unpredictable and no signal works all the time. At Capital.com, we'll continue tracking market positioning, valuations, and sector leadership, and what they tell us about where risk is building and where opportunity could emerge. As always, this discussion is intended to provide a market insight, not individual investment advice. Thanks for watching.